Welcome back to New Money. We're discussing retirement and financial planning. My guest is Daryl Bennett, and if you'd like to email, you can get my detail on the screen. Right, I cut you short. It was quite a good budget. I thought it was a very good budget.
Well, it was a good budget because commodities had run, so therefore the companies made bigger profits, so the taxes were bigger. So where the government was looking for a 20 billion hole to fill, they had got it from collecting extra taxes.
And they gave everyone some tax relief because bracket creep came in, and now those earning a little bit more are not paying more tax. There was, and across the board, a few percent reduction.
So there were, from a financial planning and from a tax mitigation or tax saving perspective, there were a few enhancements. Contributions into retirement funds has increased from 350,000 per annum to 430.
As a deduction, but the formula still stays the same.
The formula is
27.5% of your taxable income with a maximum of 430.
Exactly. And then people are questioning, and I know a lot of the asset management companies have had podcasts about, is it viable to put more money in a retirement fund over and above the 430? So that also depends on your needs. I think it is a good idea because you get a 10C exemption when you commute it into a living annuity. So all the income that you that comes out that you didn't get as a deduction going in, you'll get tax-free coming out. So that's good.
And let's just add to that, all the income earned, whether it be CGT, dividends and interest or property rental, is not taxed within the retirement.
Exactly, there's no CGT.
Yeah, exactly like a tax-free savings plan.
Exactly.
So certainly, particularly the very big higher earners who have been limited, I remember years ago people could put as much as they like based on that formula. So certainly it's something to consider. But also, I think it's also a great time to consider paying monthly now and going to your salaries department and saying, I've bought a retirement annuity, they'll adjust the tax tables for you and you'll be able to get the tax benefit immediately.
You know, listen, it makes sense. Depends if you're a disciplined investor or not, and it depends on your circumstances. But yes, if you do it monthly, well, then you get into the habit of the debit order going off every month. Some people prefer to wait till the end of the tax year and then see if they've got deductions, if they're in their own business, and top up their RA. So it's a personal preference. The second thing is the tax-free savings has gone up from, I think it was
36 to 46.
36 to 46,000, but they've still capped the 500,000
so you're
maximum.
You're going to get there sooner than you would have previously, particularly when it was 30. Yes. When it was 30, it was taking you 16 and a half years. Now at 46 years, 1,000 is taking you 11 years.
Unless in the fullness of time they increase the fee.
They probably will.
Another.
Because they also didn't increase any of the brackets, either withdrawal or retirement, under the retirement tables.
Yeah, no, they left those the same. Yeah. And another benefit they're giving is voluntary money that you can send offshore, from 1 million to 2 million rand.
Big. Okay, I couldn't believe that move.
So
big move.
So for a husband and wife, it's an extra 2 million rand.
Which is total 4 million rand.
Another thing they've done, Bryan, is they've increased the donations tax exemption from 100,000 to 150,000 per individual. Another thing they've done is that they've increased...
Daryl, let's just stop there for a second, because that's a big benefit. People don't realise. Anything, it used to be to 100,000, so 200,000 husband and wife. It doesn't matter how many children you got, maximum of 200,000, but then you save donations tax of 20%, which is equivalent to estate duty of 20% at 30,000. Yes. So you couldn't transfer assets. Yes. Now 300,000, if you think about it, in 5 or 6 years doing that, you've depleted your estate by 2 million. Yes. You've saved 400,000 rand in death duties. So people shouldn't just glibly just think about that. It's a wonderful method of actually getting money out of your estate and saving death duties.
100%. And then another good, what can I say, tax break that the government has given us is on primary residence. Used to be 2 million, it's now 3 million. So they've increased that abatement by an extra $1 million rand, which means the first 3 million profit on the sale of your property is exempt from tax, from capital gains tax.
There certainly were some very good things across the board. But let me go to some of the emails. I've got an email from Ian in Lombardy. I'm just waiting for it to come up. He says, I'm facing a real dilemma as our company has not been paying the contributions deducted from my salary into our retirement fund. I feel nervous about coming forward as a whistleblower. What should I do?
Well, that's a big red flag. Yeah. You're not allowed to do that. Companies are not allowed to do that.
Yeah, but think about this one employee. He doesn't want to go to the employer. He doesn't want to get the employee group involved because, you know, employers can make it very difficult for you. You know, we talk about gender violence. You know, there are a lot of people who don't report it,
I think
particularly husbands and wives.
I think you must follow the process. because maybe he'll get into more trouble if he doesn't follow the process. So maybe he should speak to an HR person first. If he's not getting through to an HR person, or there isn't an HR person, speak to his line manager, follow the process. And if he's not getting through that way, well then yes, perhaps go to a whistleblower.
Because he's got the Financial Services Conduct Authority.
Yes, but if he goes straight to the Financial Service Conduct Authority, they might say to him, you haven't followed the process. Have you dealt with it internally first? You've got to follow the process.
Darryl, I understand 10,000 inspectors have been employed to police the situation because it's iniquitous. If you don't pay your VAT on time, if you don't pay your PAY on time, there's enormous penalties. However, if employers don't pay over retirement funds, it has an effect on withdrawal benefits. It has an effect on the two-pot system. It has a problem on returns. All these things count. And when you resign and all those type of things. Lawrence in Liberty says, I'm an employee-appointed trustee of a pension fund, and I often find myself struggling to understand the investment presentations made by the various organisations to our fund. Could I be held liable if something goes wrong? By the way, Lawrence, you're not alone, I can tell you that. Most employee-appointed members, trustees, are not experts in investments, and I can tell you many of the employer-appointed also are not. They rely on the investment thing. But I suppose as a trustee, you are jointly and severally liable.
Well, I think absolutely, but it's up to the employee benefit consultant. If they've got an employee benefit consultant, that person must make sure when he's presenting to the trustees or presenting to the staff that they understand, and he needs to ask them if they understand. And if this person doesn't understand, he must ask for the EB consultant and approach him one-on-one and say, explain how this pension fund works.
And Lawrence, if you don't understand, resign. It's no point being a member. It's not a paid position. Just resign. Jack in Witbank says, I'm backing to get a loan from the bank because I've always paid everything in full. How does one obtain a credit score? It seems ludicrous that I must have debt to achieve this.
Well, in a funny kind of way, there are organisations that you can go to where they give you your credit rating, and I think some of them do it for free. I think the first or second one. But I mean, if you've never had debt before, I suppose it is a little bit tricky. You've got to create
a store account.
Not that I'm suggesting you create debt. I don't know how old the person is.
You have to build up debt, because if you don't get a credit rating, you just can't get credit. It doesn't mean you have to go wildly into debt. Credit card, you can pay your credit card in full. Cell phone, you can do that. Store account, you can get a good credit rating by paying it in full. Unfortunately, it is correct. You do need to get a credit rating, and I suggest you talk to one of these credit rating agencies to get advice. Alice in Rosebank says, with the two-pot system, does it still pay me to move funds on leaving my job into preservation funds?
Yeah, absolutely.
Okay, but hold on.
Yes.
Let's understand. As at the 31st of August 2024, your retirement fund was vested and you could do whatever you liked. Contributions are made in the last 18 months. It's already 18 months. 2/3 going to the retirement pot, 1/3 going to the savings pot.
Yes.
So you can't move that 2/3 out of the retirement pot into a preservation fund.
But I think if you just step back a second,
Yes.
before you go into the detail of the two-pot system and how it works, on a higher level, think about it. You're leaving your employment, you're going to another employment or whatever you're doing. You preserve the benefits. Don't think because there's a two-pot system there that you can take your money out. You can take it out the savings, whether you retire, whether you leave the company or not. The principle is that don't touch your retirement savings if you're not retired yet. Keep it invested. So yes, the 2/3 and the third can be preserved, Bryan.
But then you don't have a choice. You're leaving it to the employer to invest those funds for you.
No, or you take out your own preservation fund.
But can you move the 2/3?
You can move the 3/3. You can move all of it into a preservation.
You can do that.
Yes,
still. Okay.
absolutely.
Then Julian Bantry Bay says, I'm retiring and been offered a with-profit annuity. Is this a fixed annuity, and how does this compare to buying a living annuity? I really don't know what to do.
Well, she needs to work with an advisor and understand the different kinds of annuity. It's very complicated. And going back to your Provident Fund query where they didn't understand from the employee benefit consultant, it's the same principle. The member or the person who's retiring into a living annuity or a life annuity or into annuity with profits or no profits needs to understand the pros, the cons, how everything works before she does it.
That's become a lot harder for us, having to make sure that they do understand when they approach us as financial advisors, that they do understand all the different options.
Yes.
And that's the important thing, making sure they understand.
Yes.
And again, if you don't understand, ask again. You know, you can never ask a stupid question, you can only get a stupid answer. So don't worry about that. Alan in Woodmead says, I've withdrawn from my fund under the two-pot system. Am I allowed to put it back? The answer is no. You cannot put it back. Remember, any withdrawal from the two-pot system, you would have been taxed at what we call marginal rates. It would have been added to your taxable income. That would have pushed you into a new bracket and you would have paid tax. So you can't put it back. You can only start a retirement annuity. Kevin in Parktown says, what is the best day to retire, or on it doesn't make any difference?
Yeah, well, it depends on the time of the year, it depends on the tax, it depends what his investments are, it depends what investments he needs, if he's got discretionary investments. Oh, by the way, they increased the CGT abatement from 30 to 40,000.
From 40 to 50.
Sorry, from 40 to 50,000.
So
and I think on death, didn't it go from 200 to 300 or 300 to 400?
Yeah, it also on death.
So to answer his question, yes, if he's relying on discretionary investments, he might get an exemption on both sides of the tax year. You know, so if he retires in, say, February as opposed to after February, or if he takes his withdrawal, his redemptions, he can take it on both sides of the tax year and get the exemption on both sides.
Yeah.
But he would need to sit with his advisor. Does it make the right time? Timing is everything. So I guess it depends on what his plans are. It depends what money he needs, where he needs to pull the money from. Is it discretionary, voluntary, compulsory money? There are all sorts of factors you need to look at.
Well, I keep getting the same question about taking early retirement. Forgive me if you've heard me repeat this before. If you choose to do so, there are three important factors to keep in mind. One, you will have contributed for a shorter period. Two, you will miss out on the significant compounding growth that typically occurs in the final 5 to 10 years before retirement. And three, your funds will need to last much longer, and you must be mindful of the risks of longevity as well as retirement inflation, which is probably a lot higher than CPI. Daryl, thank you for joining me this evening. It's important to note that our program is to provide information and should not be construed as advice. Next week's program, we'll be dealing with healthcare, and if you need to get hold of me, my details will appear on the screen. I'd like to thank you for watching, and good night.